So today, the webinar title is Accounting Tax for Small Construction Companies. Okay, so if you are the owner of the construction companies and you know exactly what kind of a challenge you have, you know it, I know it. Okay, so the way we are going to go about today's webinar, I really want to go into three big areas. So when we are in that area talking, and we will address those pain points. And I know exactly what that pain point is. For example, I understand how W-2 versus 1099, and if you hire subcontractors, or if you yourself running a small construction company, you're actually a subcontractor of some other company. They don't pay you, they pay to your company, and you have your crews and that kind of thing, right? I understand. And then of course, workers' compensation is a big deal, a lot of expenses for you, and the state contractor registration is another thing. And of course, expenses, right? If you are diligent about tracking your expense, and you probably have a pretty good handle on that. And I generally speaking, I always think that whoever gets into the business, whether without or with any business knowledge or not, they are understandably good with expense tracking. But expense tracking doesn't mean that you will be able to deduct it with your taxes. Some expenses, for example, you bought equipment, even though it's $200,000, but the expense of it may not come in as 200,000 in one shot. It might be depreciated over the years, but depends on that year when you file your taxes, what kind of federal government tax incentives are, then you might end up with chance to write it all off or write half of it off and that kind of thing. So that is why people care about when new president come into the White House, what they do with the budget. What they do with the budget has everything to do how we pay taxes. If their budget is short, just like President Biden, and he's facing billions, trillions deficit, okay? 9 trillion deficit for the stuff he wants to do. The only way as a government to raise that fund is to raise taxes. Do something about taxes so people will submit and then they will make their budget. So we're still in the process of doing budget reconciliation. It's not done. So the final tax code is not available to us, but we sort of know a little bit of what they are. So we will make sure that when we talk about these three areas today, I cover that. Okay, so 3 areas I'm going to talk about: tax structure, fiscal year or calendar year. Everything about year is important. And then accounting method. Accounting method is important for construction, and especially small construction company. You cannot ignore that because you might be over-reporting your taxes just by how you do your accounting, okay? So now let's look at tax structure. That's the most common tax structure. I know you know that. So it is the sole proprietorship. You don't do anything. You just go into business. Maybe you got 1099 and you're just reporting your income under Schedule C in 1040. Then of course you have LLC, limited liability company, you have partner, you have construction partnership, and that's fine. S Corp, C Corp, nonprofit. Those are all generally normal ones. But I want to show you this chart. Okay, we're going to stay here for a little bit more. And let me just make it bigger. Why did I do that? Okay, here. This is bigger, right? Look at these ones. So I put all of the entity type on this slide already. If you look at the LLC multi-members, that is your LLC 1065. You file partnership return and the K1, your K1 goes to your 1040. So you also see a 1040 box there, right here. And then look at these. The LLC, that's a K1 goes to your 1040. You have S corporation also have a K1 goes to your 1040. Some people are sole proprietorship, so they do their LLC inside of their 1040. And all of these dotted line here that I was showing you, that just means that this entity can be elected to S Corp, C Corp. S corporation can be reverted back to C Corp, and your LLC single member that can be elected to be C Corp, S Corp, or LLC. If you are adding a member to it, you become a partnership without election, but you file your tax return separately. The reason I want to say this to you is when you are becoming a construction company with all of these risks and everything going on, and then, this is what your attorney would really talk to you about. You need to have a LLC or S Corp or corporation to protect yourself, right? And once you set up this LLC, whether you file taxes inside of your 1040 or you file taxes outside of your 1040 under a partnership return, it depends on who is your partner. If you are your partner yourself, you file that under 1040, right? That's a Schedule C. But if you partner with Ying, and we together file a partnership return. So I got K1 and you get K1. But if you partner with me, and I am not going to set up, put on drywall for you, I'll be your worst labor you ever even met if you want to try that. But I can be your partner, and just because I can, when you short of cash flow, I give you cash. Okay, if I am that kind of partner and my K1 is different than yours, your K1 will go to your tax return, become your earnings. So that K1 allow you to get child tax credit, earned income tax credit, allow you to pay Social Security, Medicare, so you have your retirement set up with the government, okay, with Social Security Administration. And I always tell folks that, I know there's a theory out there saying that when we get old, there's no more Social Security, they're going to go bankrupt. No, they're not going to go bankrupt. I think COVID-19 actually saved Social Security benefit. I'm just kidding. But it did. A lot of older people, that many Americans died over COVID-19. And all of these Social Security, Medicare benefit for the elderly, they don't have to pay it to anybody else anymore, of course, right? So there is a lot of new calculations at that level, but I am just telling you, my point to say to you is that your K1 is different than mine. My K1, I don't pay Social Security, Medicare because I was just a passive investor. Okay, and you are the one setting up the drywall and making things work. So you need to pay Social Security, Medicare when you are LLC member. And of course, you also can set yourself up as an S Corp, pay yourself a salary, right? So that is where I want to say that, yes, your attorney told you that let's shelter risk and give you LLC or give you a corporation. And then the next question would be that which one is most beneficial to me and for tax purposes? That's where you're going to come to Community CPA, right? All right, let's look at the other one. Under the dotted line, the big one, and you see C Corp and nonprofit. And the C Corp, that one, of course, you can elect that to be S Corp, right? But if it is a C Corp, you only could get out of C Corp two things. Number one, W-2, the C Corp pays your salary, then goes to your 1040, right? The other one is C Corp will distribute dividend for you. Then you will bring dividend into your tax return and report that as a dividend income. Dividend income's tax rate is not the same as the 1040 regular income tax. If you only have dividend income, you will never get earned income tax credit, because that's not earned income. That is like your investment income you got from the well-run of the company, almost like you buy Microsoft share, then at the end of the year, you got a little dividend coming in on your 1099-B. Do you remember? So that's like that. And nonprofit, of course, you can set up a nonprofit if you have the heart and wanting to help the public for a specific purposes. You know, we have clients who has a handicapped children, actually handicapped child. One of my client has one child handicapped using wheelchair, and they're in wheelchair business. So, you know, they set up this nonprofit to distribute wheelchairs to children for free. Okay, so you can do a nonprofit for your special area and your special purposes. And, you know, Mother Against Drunk Driver, that's another one, nonprofit, right? The lady who set up the Mother Against Drunk Driver, her daughter was killed by the drunk driver. So she had that purpose. She had that mission. She has that drive to form a nonprofit and use the money that's donated from her own business or other businesses or other individuals to help to, you know, prevent drunk drivers getting on the road. So that is the nonprofit. So you can see that nonprofit can pay to you as well. Although you might be the chair or you might be the initiator of the nonprofit, you can get a W-2 income, right? You can be paid W-2 if you work there full time. So now the reason we bring up this one is because we want to tell you that in your construction business, maybe you come across someone and who is working for you, and you can have them become a company. So that way, if they are a corporation, let's say if Jose is working for you and Jose set up a C corporation for himself, then you go away from the 1099 issue, didn't you? Because Jose is a C Corp, so you would pay to the C Corp. Jose will be responsible for filing income and expense and pay himself a W-2 or pay himself a dividend, whatever he wants to pay him. His company running is his responsibility, no longer yours. So think of that. If you got too many businesses or individuals to work for you and their subcontractors, if they are any of these entities, let's say if they are S Corp, if they are C Corp, and you know, if they are a LLC, you need to issue 1089. Unless they are LLC, but elected to be C Corp and S Corp, like right here. So on the W-9 form, you will have to identify them to see what they are. If they are LLC, filing partnership return, or if they're individual with their social security number or IT number, then you need to send 1099. But if they are S Corp, C Corp, and or nonprofit, you don't need to send a 1099. Okay, so I just want to mention that to you. See how that related to your small construction business. This is where we are, right? So making sure you understand the entity type, you know you can change them, and you know you can take advantage of them. They are taxed differently, and you want to find out which one is the most beneficial to you. At the same time, you understand now, if the business, if the subcontractor you work with is LLC or individual name, you must do 1099. But if they are not, they are corporation, C corporation, and even nonprofit, and then you don't, right? So when you now go to workers' comp, when workers' comp insurance comes in, they want you to list all the W-2s and also subcontractors, right? If you don't issue 1099, they're not your subcontractors. So those S Corp, C Corp, and nonprofit, they don't come in. Only the LLC. Even if the LLC, even if they are LLC, but they elected themselves to be S Corp, C Corp, you also don't need to do that. So can't just look at the name goes, oh yeah, I need to issue 1099. You really need to have that W-9. You know what I am saying. If you don't know what W-9 is, write it down and search. Go on to irs.gov, W-9 form, look at the W-9 form. It will ask you whether LLC is being elected or not. So you will know. Then that's the question, because W-9 is filled out by your subcontractors. So of course you don't have a privilege to look at how they file their taxes. You're just gonna trust what's on the W-9. So make sure you collect W-9, then you know whether you should issue 1099 or not, right? Okay, so much about tax structure and also related filing requirement, right? So one last thing, the LLC and S Corp, anything above that dotted line here, that one, these are due on March 15. They are 1 month before personal 1040 is due. Why is that? Because the K1 has to come before we file 1040, right? Everything has to be here. But anything below, they're not related. Their due date, C corporation due date is April 15. And the nonprofit organization is really depends, you know, and the C corp also really depends. If they have a different years, their due date is different. But generally speaking, nonprofit is due on May 15. If they have a January to 12 year, right? So our next subject is really about year. There is a lot of years in our conversation. I can give you example. People talking about calendar year, fiscal year, tax year, accounting year, so confusing, right? So just remember, the only year IRS cares is your fiscal year and the calendar year. Tax year refers to the taxes you file, which period you go for, and that is determined by fiscal year or calendar year. So tax year depends on fiscal year or calendar year, whichever you are on. Accounting year is also depends on the fiscal year or calendar year that you are on. Sometimes in some larger companies, the management are actually looking at a different set of financials. They will make their accounting year like January to December or any other weird ways. So, you know, that's how they do it. They call them accounting year internally. But generally speaking, if we're just talking about what's important for taxes, so you either dealing with fiscal year or you're dealing with calendar year. So now let's look at that. Let's look at what is fiscal year. So-called fiscal year is a consecutive 12 months. You could start from February to January, March to April, May to June. So any years you start 12 months later, that's your year end, okay? So you may ask me, okay, why, if I have a construction company, and why it is that important for me to have a fiscal year? Give you example. If, you know, I know a construction company who does swimming pool building, like their specialty is just building swimming pools, okay? So when is the time people build swimming pool? For sure, not in the winter. And especially I'm in Midwest. So the winter is really winter. Nobody can go into the swimming pools, okay? So when you talk about building swimming pool, that must be starting sometimes in April. Then you build all the way to the summer because people are just, you know, the hotter the summer is, the more pools the swimming pool company gonna build because people just suddenly realize, I like to have a swimming pool. So their busy time is from March all the way to September, okay? So after they finish that, actually to be exact, to August, because I kind of remember their book, and people really don't do that into the winter. They don't build pool to go through the winter. Everybody is building in the spring, and kind of left the end of the tail for swim a little bit, then they close down the pool. So it's from March to August. So this company has this seasonal thing. From March to August, they made a lot of money. So let's say if they made $1 million by the end of August, and if they, you know, if they are closing, let's say if they have a fiscal year ends on August, that would be sad because they just made all the money. They haven't even had a chance to spend anything yet. They already start paying taxes. Am I right? Because you have to add, you have to make your income minus expense, then the net profit is paying taxes. So in this case, this swimming pool company, their fiscal year actually starts, their fiscal year actually ends after August. They give all the way to March, okay, to get that fiscal year extended. So they made money from April all the way to they started in April, so they end in March. So they will be starting from April 1st all the way to next year March, and then they will have that 12 months. So in March, because all the money was made in August, you can imagine that it is pretty much spent. Does that make sense? So fiscal year is important. Depends on your season. And what kind of company would go into that? Food truck, outdoor adventure business, and a personal trainer, lawn care, and Christmas lighting, and the, chimneys sweeping, those old, those old, I call them old business. Better my client who are doing that though didn't hear me. It is still a good business, but it's not as good as 20 years ago, I will say. And the specialty retailers, they also are seasonal, right? So that is why people has fiscal year. So in construction, I think you also have that problem, right? So that is the slides I was talking about. So going back to here, and now the calendar year may not be the best for you. Let's say if I am the one setting up Christmas light, didn't we get that all done by the August? By the December, I mean, everybody pays me and I pay taxes right away. So you may think of something else. So that is another consideration for construction company. Now let's talk about this accounting method. This is actually very heavy piece for construction company. We covered tax structure. We covered fiscal year, just 12 months. 12 months means which one, right? Then now we're covering accounting method. This is all related to how you account income and expense, okay? So accounting method, most general ones, accounting method is the one what we see here. Accounting method, normally, if you look at your tax return, it actually asks you, what's your accounting method? So you choose cash method, accrual method, then there is another one called others, okay? The others is for you because you don't want to be on cash method. So what is cash method? Cash method, I want you to say that, I want you to see this list I made. Cash basis, cash method. So generally speaking, and you can take a picture of that, but generally speaking, cash method just means that if the money is deposited in your bank account from your customer's check, okay, that means you received it. But in construction, how many times you receive money ahead of time? You did not even start the business yet. So normally when you start a large project and cost the customer 120,000, then they actually give you 60,000 in advance because you were asking for down payment. But you didn't even work. Did you make that 60,000? You didn't. So are you willing to pay to say that, well, 60,000 I made it, so I didn't really buy any material yet, so yes, IRS, please charge me 60,000 times the tax rate, and I am okay to pay about $12,000 taxes. You probably will say, no, Ying, that's why I've been paying taxes too much. I don't even have money. So this is where you're on the wrong accounting method. Okay, so of course, cash method means that you receive the money is your income. And if you pay money, let's say December 31st come around and you got a bulldozer you really want to get and you paid it, but it wasn't really, they didn't cash your check and you wrote that in December, but somehow the check mailed out and they still didn't take it. Can you deduct the bulldozer? You can't because you didn't pay for it, because it didn't go out of your account. That's cash method. So to make it simple, cash method is almost like your bank account. Like you really stuck with it. If you receive it, it's your income. If you run it off, it's your expense. If you wrote a check and didn't clear, sorry, too bad. Very sad, you cannot deduct. Okay. Now, accrual method. That's another box on the tax return. Cash method, accrual method. Accrue means that as long as you know income is coming, and you should book that as an income. And later on, if it didn't come, you can always write it down by, receivable allowance and that kind of accounting method you can always do. And as long as you wrote a check, if it is not cleared, and you can still deduct, that's accrual, okay? So income includes what's not yet received. So in construction, you got this big project going on, 120,000, and they give you $60,000 deposit, and you're on accrual. Oh yeah, you're on accrual. Then you should report 120,000, even though the other 60,000 you didn't receive it. You're like, no way, Ying, I'm not going to do that because my customer may not even pay me that much. That's okay. You can still on accrual. You can still report 120,000, pay a lot of taxes in 1 year. Next year, the deal was canceled. Customer didn't even come to you. And then you just reverse it. You just go into and reduce your income. And so reduce your income that for the next year. So you see how that doesn't really match up to your feelings, right? You feel for the moment, for the present, but your accrual method is like in the future or in the past. So it's just not at the present. So that is the challenge for a construction company. So now there is a thing called accounting considerations for a construction company. And there is a three other method that you should count your income. One is percentage completion. The other one is use completed contract method. And then option, of course, is cash method. I don't recommend that, but go ahead with percentage completion. What does that mean? That method is the contractor recognized revenue by apply the estimated percentage of completion to the total anticipated profit. So let's say you have a 120,000 project, okay? And when you finish 100%, your anticipated profit, let's pretend, is 10%, what, 12,000. So percentage completion is that you will say, okay, at the end of this year, 50% completed. Then what do? You will report $6,000 profit because that's percentage completion. Okay, so you can do that. This is the one that the government requires on large corporation, large construction company, their mandate to use that. They have to use that. But you, of course, small ones don't have to. So my small construction companies, I just want you to know that is how it works, but you don't have to use it. But you can use alternative, use completed contract method when it is not possible to determine the percentage of completion project. The contractor recognizes all of the project revenue and profit only when the project has been completed. Okay, see, that gives you, so you have a contract. So you sign a contract for 120,000 and you're just gonna recognize revenue at the end when you finish it. Wouldn't that be cool, right? That is your other method. It's not your cash, not your accrual. It is called completed contract method, right? So you may say that, well, Ying, now it's too late because my construction company had cash method checked all these years. Of course, you got cash method checked because, you know, the tax software actually default all the accounting method into cash. So if there's no consideration of you or your tax preparer, and the software was very smart, will just put you on the cash method regardless. Even if it is really disadvantageous to you, the software doesn't know and they just default on the first one. So let's say you are already in cash method. Now you are like, oh, Ying, I really want to use completed contract method. Then you need to change your accounting method. When you change your accounting method, you need to fill up a form. And that form is called a 3115. Okay, that form, not the easiest one. So if you do consider to change your accounting method, or if you do consider the, you know, your company structure just not really well, if you do consider the seasonal factors that you are facing, then maybe it is time to consult with Community CPA to figure out what is the best for you. All right, so this is a two obvious issues that our small contractors have, and I want to address that for you. So a lot of times my small client my small construction clients, they finished building the house, right? So most of the fee were paid, but they're just like 10%. They don't get it until a year later. They call that retainage. They were like, we'll pay you, but we need to, sit in this house for a year before we can give you that 10%. So what do you do with that? So when the amount billed on the construction project is greater than the cost incurred, the difference is treated as a liability. Okay, this is the liability. Let me read the second paragraph, because this is overbilling liability, and this portion, this first bullet point is for that one. So contractor retainage is the customer may withhold specific amount from the contract price, right, until satisfied with the completed work. And this may still be recorded as receivable, but could be classified as a long-term receivable if customer has the right to hold the amount for more than a year. So see, receivable. Receivable is what? Receivable is you didn't get it, right? So you can treat that as a receivable, folks, and have that on the book. And if you use the accounting method accordingly, if you do accrual, that receivable will be accounted as income already. But if you do cash, like the third one I was showing you, then the retainage would not come in. But you use completed contract, and this one, you already complete the contract. They're just holding that on you, and then you can recognize your completed contract with a portion that is still not there, not finished yet, right? So if they got anything wrong, they would come back to you to fix it again. So making sure that, and you give that, use completed contract method, and when it is completely completed, all right? So that would give you a clue of how you would do that. So this overbilling liability, when the amount billed on the construction project is greater than the cost incurred, that means you actually billed too much and the cost is less, right? So the difference is treated liability of the contractor until the cost incurred caught up with the billing. So, you don't recognize as a revenue, because you will eventually caught up, because you just, maybe the material got delayed, especially right now, the delaying is month, okay? You probably overbilled, but that's okay. You don't recognize as an income, and you recognize as a liability. So when they go on to liability, again, goes on to your cash method. If you have a cash method, sorry, you overbilled, you should report that as an income, right? You cannot do delay when you are on cash method, because you go for what you received. But if you are completion method and you are contract completion method, and you see, this one would not affect you at all. And if you are accrue method, and you would just accrue that, so that would come in as your liability. So it doesn't, it will be coming your expense, right? I'm thinking while I'm talking. If it is completion method, no, if it is accrual method, the liability, the overbilling will be recognized as expense because it is accrual. Okay, so that is how these two are very well easily happen in construction world. So one of them is you overbilled, the other one of them is you are not getting paid. So both are balance sheet entry, so has a lot to do with accrual accounting. But if you are on the other method, then these are not going to be an issue for you. Now, let's look at cost side of things, right? We talk about income, and we told you that how important that is to know your income recognition method. Are you cash, accrual, or your others? When you're others, what are the others? Completion method, and the other one is the contract method, right? I go back to that one to make sure I say it right. Completed contract method. Okay, this is the other one. All right, now let's look at cost. And so in construction, I want to talk about, there's of course a lot of big deal, big deal construction company, they have software helping them. But for my small, medium-sized construction company, let me explain to you about indirect cost. So when you give the bid to a work, I know you're pretty good with material because you check that out and you know how much bricks you're going to buy, you know how much drywalls you needed. And also labor side of things, some of the construction company are using the material to drive the labor. So they go, if the material is $100, then it's $100 labor. So they go that way. Or they're also some construction software, they will give you the jobs and they will, map out the labors for you. If you're drywalling by square footage, they already know how much labors you need. So they calculate labors relatively accurately, even if without software and in terms of your own experience, you would do that pretty good. Okay. So with that, what left to you is your indirect cost, which means that it is your back home cost. It is what, if you're a guy running the construction company, is what your spouse cost you. You're not home, you're busy all the time. You think that doesn't cost you? You're wrong, because she'll make you give her more money to go shopping, or he'll be making you feeling guilty and to work so much, so you felt like you need to spend more money. And I'm just kidding, right? But in business, there is an indirect cost of supporting staff, just like in community CPA. And of course, we have accountants, professionals, lawyers, and the tax accountants. We have them, but there's also support, right? So the support, the rent, the building, the people, the secretary, and the computer system, all of these are indirect costs. So what you should do, based on my experience with 10,000 clients, and I will tell you that when you are small, you don't need to invest in anything too fancy. What you do is you take your tax return from last year and then look at all the expenses that are on the tax return and go find your total job in that year. So maybe you know that, okay, I made $1 million sales. I also have 500,000 expenses. And I'm not counting on cost of goods sold materials, because that one, you're supposed to get it back from your client, okay? So if you cost $50, you're supposed to get $50 plus your charges, right? You can combine them, but you know how to calculate that. So you do material, you do labor, then you do indirect cost. The indirect cost, and you can literally give that rate to every dollar you sell. So in my example, $1 million sales, and I have 50,000, I have $500,000 indirect overhead cost. So my rate will be what? 0.50, right? For every dollar I spend, I have 0.50 cost overhead. Then when I do my calculation for a new customer, I would apply that 0.50 to the price I quoted based on material and based on labor. So I don't go into guess that indirect cost. I have a real number. Of course, 0.50 cents per dollar, that's too high. I think most of the construction company I see on my book, it is about 0.7. So 0.17. So 17%. So that would be the overhead, then plus materials. Materials normally is right around 50 or less. Okay, so you already have, so you're supposed to make a margin of 33% in real construction world. So you just make sure that you add that 0.17 to your calculation. So let's say this job is 120,000, then you just use 120,000 times 1.17. So that will give you 140,400. So that is what you're going to quote to your customer. That is what I want to talk to you about, indirect cost. Okay, so you don't have to look into QuickBooks. You don't have to do anything. You must filed your tax return last year. Just use your tax return from last year to do analysis on that. All right. So of course, if you are bigger than small, and also not too big, then you have these issues related to equipment, and also equipment transportation cost. That would be something you consider. But normally when you booked it for, when you did taxes with us, let's say you did taxes with Community CPA, we have already considered that in your expenses. So if you have that kind of activity, your accounting must be already set up that way. Then we know how that mobility would cost you. So that would become another factor to come to you, okay? So to come to the calculation. Now, so this is more of the selecting the best accounting method, and we summarized it here, and I told the one called the completion percentage completion method. Remember, this one is to ask you for the profit, then percentage of the profit you report as taxable income, and that is not required if your revenue is under 25 million. So I just want to point that out to you. So this is really, in a nutshell, this is what we want to talk about today. And I hope that is helpful for you. And now with Biden's tax changes, and it would not affect your 2021 folks, because we are kind of, we're at the tail of the 2021. Let me stop sharing that. We're at the tail of 2021, and you want to make sure that you plan 2021 with 2022 in mind. Generally speaking, I would just say there are 3 big changes for sure coming, okay, for 2022. Number one is the IRS audit. The audit rate will increase for sure, because Biden had made budget just to supply to IRS, to have them have more auditors, to have them to come into you and knocking on your door more often. If you are already being audited before, you are definitely on the right, on the list that to be audited again, because once you get audited, you tend to get audited again, okay? Then if you have never ever got audited, it is 2020 would really be an important year. Actually 2021, it would be important year that to get your tax filed properly, so you don't get flagged out for things that was not done properly. And that's number one big thing. Audit is increasing. Number two is our C corporation. C corporation, a lot of C corporation is in the pipeline because of President Trump's tax reform, lowered C corporation taxes down to 21%. It is for sure increasing it back, increasing it to what? Not set in stone, but so far the House and the Biden's proposal talk about 28%, which is raised from 21 to 28. And the House proposal actually says that from 18% to 28. So there's a graduated rate. If you are a smaller business, you actually pay less. But if you're a bigger business, you actually pay more. So that is the number two. Number three, you want to know related to the Biden's changes is this $400,000. This is kind of like buzzword. Not buzzword, is a buzz number, and it is a number that's separating you from the tax changes. So if you are below 400,000 threshold, there's a lot of tax changes that President Biden is putting out would not affect you. But if you are making more than $400,000, and in the past and or in the future or in 2021, 2022, and going forward, and you are looking at the calculation to be different, that effective date should be January the 1st, 2022. So nothing to be really alarmed for 2021. There's only one thing I see they could retroactively back into 2021. That's a short-term capital gain. Short-term capital gain could become taxed just like the new personal tax rate. They raised that from 37 to 39 already, though that's pretty consistent in the proposal. So I'm pretty sure that would go in. So capital gain, they might started taxing you high in 2021, which means in 2022, when we prepare tax return for 2021, that may kick in. So I just want you to know. Okay, so these are the three things the Biden's administration are putting out. And, you know, of course, there's a lot more things not so related to our subject here, but I want to make sure that you come to our YouTube channel and watch what we have for you. We try to educate ourselves and at the same time and put out the knowledge. And we do have a team of professionals who does these research and you know, giving out these knowledge to internal folks, so we can always be at the front end of the knowledge. And when you open your mouth, we know where you are going with your question, instead of, you know, sometimes I wouldn't say a lot of time, sometimes my client educate me. It really do happen. And I wouldn't say a lot of times, but there are times. So they sit in my office or they be on the Zoom. They say something. I'm just like, I don't know anything about it. And then of course you go back to study and then you realize, oh yeah, that is a whole new things that we never explored. And of course, maybe my client don't even use it, but they heard the buzzword, then they come over. So we study, but those are good learning for us. And we try to literally eliminating those kind of surprises, always making sure that our knowledge is enough, and to make sure that we don't have things that we could not consider or we don't know to consider. So with that kind of learning structure or system we put in place, we hope that you're always getting the best. All right, and I'm so glad you're here on Saturday. Saturday, you should go out to walk. And today in Des Moines, sunshine, nice breeze. It's just beautiful fall. We have a lot of red leaves. And, you know, I miss that because I'm from Toronto. Around this time, the whole, you know, Down Valley Parkway is so beautiful. Really miss that. So I felt like this is the time you need to go out, and I really appreciate you're here, and let's talk again. Okay, I will see you around on Zoom. Bye-bye.